Okay, good evening, everyone. I think we have a reasonable number to start the class. I don't want the class to stretch too long into the night, and I don't even know how the network is going to treat me tonight. It's raining heavily here. I hope the network will be nice with us. So, before we move ahead, kindly confirm if you can hear me clearly. You can hear me clearly, please show some emojis for me to be sure. Okay, all right, good. All right, um, welcome everyone to tonight's class, the Ipsas 2025 free lecture series, and I want to believe this is about around the 22nd or 23rd class we'll be having this diet on Psaf. So which shows we've really gone a long way, and I commend your commitment, your tenacity to ensure that this I can to see it through. I can see that some some flame of book is showing from this group, from this call. I can see people that have read seriously. They are boiling with PSAP. It is well. All the best. So tonight we'll quickly, in maybe an hour or thereabouts, we quickly go through a couple of standards. So before we go further, let me state that PSAF has one peculiarity when it comes to the issue of standards, and that is the fact that the PSAF examiners do not have a trend in terms of testing standard. Unlike the FR examiner, that we know that we can easily predict some certain standards that they usually test. That even if at all they will test the one that you don't know, you shall know some that they likely will test this one. You understand in FR. So that is not the case in PSAF. There are quite a number of standards, and sometimes they don't even test any. Sometimes they test maybe one, two, and it's even difficult to predict which one because they are not used to repeating standards. So the reason why I'm saying this is that it's so that you don't put too much energy into studying only the standards, and then they end up bringing only one as part of one question. So I'm not saying you should not study standards or study it, but don't spend too much time. There are about 42 topics in the syllabus, and 42 chapters in the syllabus. So, and that is the reason why I'm trying to just let us know the reason why we are bringing in standards this late in the lecture series, because we want to try and cover other areas before we now come back to standards. Okay. So tonight we'll be looking at Ipsas 43. If time permits us, Ipsas 43 is leases. If time permits us, we'll also be looking at Ipsas 9, and which is the revenue from exchange transactions, and Ipsas 16, which is investment properties. Now, also, I would like to let us know that one good thing about standards in Psaf is the fact that majority of the standards in Psaf have they have IFRS or IAS equivalents. So, which means, and maybe to a very large extent, the content are almost the same. So, which means if you know the IFRS equivalent or the IAS equivalent of a particular standard, at least you know that even if you don't, if you just meet the standard suddenly, then you can be able to do something, work something around that standard. So, for example, if you know your IAS 16 very well, which is PPE, so if they bring Ipsas 45, Ipsas 45 used to be Ipsas 17, they changed it to Ipsas 45. They used Ipsas 45 to replace it. So if you see Ipsas 45, the provisions are largely the same. All right. So, and others like that, if you see Ipsas 5, which is borrowing costs, the same way you treat borrowing costs under VIS 30, sorry, something, I can't remember. So that is just the point. So if you know a particular standard very well under the IFRS or IAS, at least you can use the knowledge very well under Ipsas. So without wasting time, uh, unfortunately, I'll be sharing from. Okay, let me share my screen on my phone because I'm connecting with phone, but that would still not say I should not share. Let me share the screen. Okay, so when you see my screen, let me know if you start seeing my screen. Let me know so that I can be sure it's showing already. So indicate with please indicate with emoji once you start seeing that my screen is showing. Okay, good. Okay. I hope it's not. I hope the screen is clear. Okay. So also, if you okay, it's not clear enough. Okay, maybe I'll change it to landscape and hold it. Okay. Okay. How about like this?
Is it okay like this? It's clear.
Okay. All right. So you can see I'm sharing on phone. So if you have a very important observation, don't raise. If you raise hand, I will not see because I'm sharing from phone. So I'm not seeing the call page now. So if you have an important observation, just talk so that I can know. All right. So we're talking about Ipsas 43, which is on lease. Ipsas 43 leases used to be treated under Ipsas 13, but now they have replaced Ipsas 13 with Ipsas 43. Okay, so what is a lease? A lease is simply a situation in let's in simple English. A lease is just a situation whereby somebody owns an asset, another person borrows it, and then pays the owner of the asset for borrowing the person's assets. That is what a lease simply means. All right. So In more technical terms, the person that owns the asset that is borrowing another person, they call him the lessor. And then the person that is borrowing assets, and the person that is doing borrow is known as lessee, and it pays the please everybody should mute. Let us all mute our mics, please. Please mute your mic. Thank you. So the lessee is the one that is doing borrow, like you said, and then he pays the lessor, who is the owner of the asset. He pays him what is known as lease payment. So it's usually a contract whereby one person owns an asset, borrows it to another person, or say rents it. Please now, please mute your mic, please. Please mute your mic. Who is that person? Please mute your mic. That sound is stopping others. So he borrows it to another person, the person uses it and pays the owner of the asset. That is what a lease contract is about. Now, in a lease agreement, the asset that is being leased is usually referred to as a right of use asset. Now, it is important to note that lease are usually used for assets that are non-current assets, right? Non-current assets are the ones that usually list. You don't list current assets. You cannot list cash. You can list. Can you list debtors? Mhm. So we usually list non-current assets, and it's usually for a specified period of time that would have been agreed between the two parties. Now, in a lease, there are two forms of lease. So the main thing that happens in a lease is that one person borrows another person assets to use, but it can now come in two forms. All right. So the first form is that the the owner, sorry, the ownership rights and risk of that asset will be transferred to the person that is borrowing, that is the lessee. Okay, the lessee who borrows assets will bear the ownership rights and the risk. That is, apart from the fact that the asset will physically reside with him, all risk associated with ownership of that asset will be borne by him in terms of maintenance, in terms of security, where taking care of the asset will become his responsibility. And of course, any benefits that is associated with owning that asset will also become his own. And that is known as a finance lease. Okay, so a finance lease is a situation where the ownership right and risk of the asset is transferred to the lessee. Okay, and it's usually for a long period of time. Apart from that, it usually covers all or most parts of the lifespan of that asset. Okay, so that is a finance lease. Now, the other form of lease agreement is the operating lease. Now, the operating lease is a shorter form of lease. It involves a short period in the life of that asset, and in that operating lease, the ownership rights and risk of the asset is retained by the owner of that asset, which is the lessor. So the lessor retains ownership for the assets. He just lease the asset to the lessee for a short period of time and then collects back his asset. In that period, the risk associated with ownership or any other benefit that's associated with ownership of that asset will still be will still belong to the lessor, who is the owner of the asset. Okay, so I've talked about the right of use asset. The right of use is the particular asset that is being leased. So it's usually referred to as the right of use asset because in an entity we have non-current assets, and non-current asset now, before, non-current assets used to be just non-current assets. You know that they are paid assets, but nowadays non-current assets can come in different forms in an entity. So non-current assets can be tangible, can be intangible. Okay, we know the intangible ones: patent, right, trademark, and all of those things. Then the tangible ones now can still come in different forms. So part of it is PPE, that is the one that you know before. Part of it is now right of use assets. Another one is investment property. Okay, so all of these that I've mentioned, they are all non-current assets. So that is why the one that is on lease have its own name separate, so that it can be easily identified, it can be easily distinguished in the statement of financial position, that this one is on lease, this one is owned, this one is an investment property, and all of that. So the asset that is leased, that's the main point there. The asset that is on lease is known as the right of use asset. So that when you see the statement that they mention right of use asset, you know, start getting confused and which one does, what does this one mean again? Then lease payment. Lease payment is the payment that the lessee, the one that is borrowing, makes to the lessor. So any payment, any money that the lessee is paying the owner of the asset is regarded as lease payments. Now, lease payments can be in different forms. At least the kinds of payments, the forms of payments that the borrower will be making to the owner is in different forms. Okay, so this payment in, uh, said they are payment made by the lessee to a lessor relating to the right to use an underlying asset, and it includes fixed payments. So in a lease, you know, we said it's usually for multiple periods of time. So in that period, the payment is usually a fixed amount over the period. That is a fixed amount annually over the term of the lease contract. So there's usually a fixed payment, and then there can be variable payments. Apart from the fixed payment, there can be variable payments. That is that one that will be dependent on a particular rate or a particular index. So depending on that will be dependent on the agreement that they already have about the lease from the set go. All right. So that is another form of payments that the lessee may be uh, under obligation to make to the lessor. All right. So then the price of a purchase option is also a form of payment that the lessee may want to make to the lessor. Now, a purchase option means that after a lease term, at the end of a lease term, if it is in the agreement of the lease from the beginning, the lessee may have the option to purchase the asset from the owner. So the lessee may have the option to purchase the asset from the owner. Okay, so let's say you have a lease agreement. I borrow you my assets, use it for 5 years. Now we can have an agreement. It can be part of our it can be part of our agreement that if you use it for that 5 years, after 5 years, if you wish, you can buy the asset. So that is a purchase option. So if the lessee decides to exercise that purchase option and buys the asset at the end of the lease term and pays that purchase amount to the lessor, that is another form of lease payment. Okay, so another form of payment that can also be involved in a lease agreement is penalties for terminating lease. So if you have a lease and then one party decides to terminate, especially the lessee decides to terminate the agreement before the end of the lease term. Okay, so if it is part of the agreement that this lease is for 7 years and it we cannot break it. So if the lessee decides that okay, they want to break the agreement before 7 years, then they have to pay some penalties to the lessor, because you know that the lessor has already planned that for the next 7 years I'll just be eating. I've borrowed my assets to another person. For the next 7 years, I make the person just dey pay me money make I dey shop. I no have stress. But now that after 5 years, you now say you are not doing this again, you want to return the assets to the lessor, you now start looking for another customer to rent the asset. So in that case, the lessee may have to pay penalty. So if they pay penalty, that's another form of payment that can come. So we are just looking at the different kinds of payment that can flow from the lessee to the lessor. So another one is uh, lease payment to expected to be payable by the lessee under residual value guarantee. Okay, so there is what is known as a residual value guarantee. That is, if you want to have a lease agreement, and then the lessee guarantees that at the end of this lease agreement, whatever is the scrap value of this asset, the lessees decide that they will guarantee a certain amount of it, that they are sure that these assets will be worth at least this amount. So let's say I have a car, I'm borrowing it to another person on lease, and then the person says that after 5 years, that car will still be worth 1,000,000 naira. And then we put it in our agreement that the person will guarantee that after 5 years, that car will still have a scrap value of at least 1,000,000. So in a situation like that, once it is 5 years, the lessee will guarantee to pay at least that 1,000,000 naira as part of the scrap value of that asset to the lessor. So even if they now eventually sell the asset and it's not up to 1,000,000, the lessee already know that they will guarantee 1,000,000 that will go to the lessor. So that is a residual value guarantee. So by the time the lessee is paying that amount, is one form of payment again that can flow from the lessee to the lessor. All right. So we've talked about fixed payments. That is the payments that is made annually from the borrower, the lessee, to the lessor. Then there's another term known as the uh, gross investment in lease. Gross investment in a lease is the sum of the lease payments that is receivable by the lessor under a finance lease, or and any unguaranteed residual value accruing to the lessor. So this one is saying that all the monies that the lessee will pay to the lessor for the period of that lease is the gross amount, uh, gross investment in the lease. That's the gross investment of the lessor in the lease. All the money is expecting from that lease. Now, that money, they will flow into the future. So if the value of the assets, let's say the value of the asset is 20 million, and the lease is going to be for 5 years. So what it means is that that 20 million will be spread into 5 years. All right. Now, if you now want to know the present value of all those payments that will be made into the future, right? The annual payment that will be made from year 1 to year 5. If you want to know the present value of it, discounting it to present value, that is what is known as the net investment in the lease. And then the difference between that gross investment and the net investment is known as the interest in the lease. Okay, so now you can also have what is known as an initial direct cost. Initial direct costs are costs that are incurred whether by the lessee or by the lessor as a result of that lease agreement. Okay, so any of the two parties can incur costs directly on that lease. So if it is directly incurred as a result of having that lease, so it will be regarded as an initial direct cost. So those costs are usually added up to form part of the what is regarded as the cost of the lease to the lessee. And then there is the interest rate in the lease, that is the interest rate, the interest rate at which the net investment in the lease is calculated. Then there can be a lease incentive. Now, lease incentive is like something that the lessor decides to offer in order to ease the burden of the lessee. So that is known as a lease incentive. Let's look at some examples. We want to have a lease. I have a machine. Let's say I have a caterpillar or some crane. I have a crane, and then I want to lease it to one construction company. You know that once we sign the lease agreement, normally they will be the one that will come and carry it and start using it, because it is now they now have the ownership risk and the ownership rights. So they will be the one to come and carry it from my own place, and then they start using. But if I now decide at the lessor and decide to carry the machine to them, I've saved them the cost of carriage to their place. That cost of carriage that I've saved them is an incentive. Or maybe I decide that, okay, I will pay the insurance on the machine for you, or the 40-year payment of the insurance on that machine. I decide to pay it. It's a form of incentive. So a way of easing the burden of the lessee. So if lessor, that is the owner of the asset, does any of something like this, is known as a lease incentive. All right. Um, so before, okay, now let's look at briefly the differences between the finance lease and the operating lease, the two forms of lease that we say we have. Now, for a finance lease, there is usually a purchase option for the assets, which is not most of the time not usually available for an operating lease. And the reason is because, like I said earlier, the finance lease occupies most or all the estimated useful life of the assets. So let's say an asset have an estimated useful life of 20 years, and then we have a finance lease of 18 years. So after that lease, wetin remain for the life of the asset again? 2 years. So in situations like that, there is usually a purchase option in the agreement that, okay, after the lease expires, you have the option, if you are interested, to just buy the asset. So you just pay the scrap value of the asset to the lessor, and then it fully becomes their own. The asset will fully become the that of the lessee. Though that is not usually available for an operating lease, because operating leases are usually for a short period of time. An asset that is supposed to last 20 years as estimated useful life, and then you lease it to somebody for 3 years. That means after the lease, the asset will still be good, you still have a lot of time, so you cannot just sell it as scrap at that level. So that's one of the differences. Another difference is that finance lease is usually used for assets that are not easily replaceable, expensive. Yeah, they are not quick to get, maybe like buildings, like some heavy machineries and so on. But operating lease are usually for items that are easy to replace. You know. Then, in the case of a finance lease, it has the ability to continue the lease for a secondary period, which is not usually available. So the secondary period will now be at a lower consideration. All right. So if the asset that we said is going to last 20 years, and then we lease it to somebody for 18 years. Now, apart from a purchase option, they can have an option of a secondary lease. That is, instead of terminating the lease like that, we'll now start another one. And since the asset is still good and can still work like 5 more years, why don't we just lease it for another 5 years? So, but in that case, we know that we already know the asset is weaker this time, so the consideration will not be as high as it was in the beginning. Okay, but that is not usually available for operating lease. For operating lease, if you want to renew the lease, you renew the lease at the same rate, or even maybe even higher at higher rate. So that is those are some of the differences between an operating lease and a finance lease. Okay, any question so far? Okay, all right. So let's continue and to look at what are the provisions of the standard as regards the recognition of lease, the measurement, and the disclosure requirements. That is, how do we recognize a lease asset in our financial statements? Then, if we want to recognize it, how do we measure it? At what amount are we going to recognize it in our financial statement? That's measurement. And then disclosure. What are the things? What are the details that we need to disclose in our financial statement regarding a lease contract or a lease agreement? Okay, so let's look at, lease involve two parties now. We have one asset with two parents. Only one asset have two parents. The lessor is there, is the one that bought the asset, the owner of the asset gangan. The lessee is there, is the one that is borrowing. The two of them are exercising rights on the same assets. Okay, so how does the lease agreement, how will it look like in the book of the lessee? How will it look like in the book of the lessor? So how is the lessee going to be keeping his records in respect of the same asset, and how will the lessor will be keeping his own records in respect of that same asset? So let's start from the book of the lessee, that is the one that is borrowing assets. Now, in the book of the lessee, they will recognize a lease asset. They will recognize it as part of their assets in the financial position, and then they will also recognize the obligation that they have to make, that is the payments that they have to make. They will recognize it as liability. So it will be like an in and out. So it will enter as an asset, also enter as a liability. Okay, because they exercise the ownership rights on that asset. So that is why it will be recognized in their financial statement as an asset. It will be included as part of their non-current assets. In fact, they will even depreciate it. Okay. At the same time, the money that they have to pay to the lessee, to the lessor rather, the money they have to pay to the lessor as rent of that asset into the future, all the amounts into the future will also be recognized as liability in the um, financial position. So you are recognizing it as asset, you are recognizing it as liability. That is how to recognize lease in the financial position. Now, that is in the book of the lessee. And then, of course, that is in the case of a finance lease. All right. So that is in the case of a finance lease in the book of the lessee. So how do they measure a lease? So how would they measure it? Now, at the initial stage, when the lease happens, the initial measurement will be at the commencement date of the finance lease. So at that commencement date, the lessee will measure the lease at cost. Now, what is the commencement date? The commencement date is the date that the lessee begins to have rights over that asset. All right. And then they will recognize that asset at cost. Now, what is the cost? They are not the one that bought the asset, and we are saying they will recognize it at cost. So, what is the cost to them? The lessee is not the one that bought the asset, right? They borrow it, and now the standard says they should recognize it, they should measure it in their financial statement at cost. Now, what is the cost to them as an entity that is borrowing assets? Now, the cost of that asset will be one, the amount of the initial measurement of the lease liability. What is the lease liability? Remember, the lease liability is all the money that they have to pay to the lessor. I'm borrowing a tractor from you, and then we agree that I will be paying 2 million every year for the next 6 years. 2 million every year for the next 6 years, 12 million. That's what I will pay. So that is what I'm owing you. So that is the lease liability to me. And so I will record the cost of that asset is one, the lease liability to me. Two, any lease payment that is made on or before the commencement date minus any incentives. So if I make any other payments apart among all the lease payment that we have mentioned earlier, if I make any other payments, if I make any payment on the date of the commencement or before the date of the commencement, it will also be capitalized as part of the cost. Understood? So it will also be added as part of the cost of that lease in the book of me, the lessee that is borrowing. Another component of the cost is what? The initial direct costs that are incurred. Maybe we involve a lawyer in the agreement. Maybe we involve some engineers to install it, else any other initial direct cost, any other initial cost that is directly incurred as a result of that lease agreement. It's also part of it will be added as part of the cost of that lease. And then if there's going to be costs to dismantle the asset or to disinstall it, to uninstall it, or whatever, or even to restore the site to its normal condition, all these costs will be estimated and then will be added as part of the cost of the lease. So this is the amount at which that property will be recognized in the financial statement of the entity. All right. Now, okay, the initial measurement of the lease liability. Now, they are even we are getting a further explanation on what is the initial measurement of a lease liability. Uh, that involves the present value of the lease payments that are not paid at the date, at that commencement date. All right. So that is the initial measurement of the lease liability. All the lease liability that have not been paid, the 2 million that I said I will pay in future for the tractor that I'm borrowing from you, that 2 million discounted to present value, okay, is the um, initial lease liability. Okay, so it's also involved the fixed payments minus any incentives, any variable payments, amount expected to be payable by the lessee under residual value guarantee, and then the purchase option price. All these together, discounted to present value, is the initial measurement of the lease liability, which will now be recognized as the cost of the asset if there is any other cost that is now added to it. Okay, so subsequent, that is the initial measurement for a lease in the book of the lessee. Subsequently, how are they measured? So subsequently after the commencement date, the lessee will measure the assets by applying whether the cost model, the fair value model, or the revaluation model. Okay. Now, the cost model is the most common way. That is, they will recognize it as cost, like we have discussed above, and then they will less accumulated depreciation or accumulated impairments in their financial position. So that is how they will continue to measure it till the end of the lease agreement. In alternative, if they are not using cost model, they may use the fair value model, and that would be in a case where the lease asset meets the definition of investment property. That is, if the entity is using fair value model for their investment properties, and this particular assets that is on lease meet the definition of investment property, then they will also use fair value model for that particular asset. So that is another reason they may not be using cost model. Now, another reason they may not be using cost model is that they may use the valuation model, and that will be in a situation whereby the asset belongs to a class of assets which that entity usually apply revaluation model to. Okay, so if the entity usually apply revaluation model to a particular set of assets, and this asset that is on lease is now uh, is now part of that class of assets. Maybe let's assume that they usually apply revaluation model to their buildings, and then they now lease. They now have another building on lease. They borrow another building on lease. In that case, they will also use that revaluation model that they are using for other buildings. They will use it for that same building as well that is on lease. So, so that means they will not be using cost model in that situation also. So those are the subsequent measurement of lease assets. Okay, so very quickly, let's look at the presentation and disclosure. So how are these assets presented in the financial statements, and how are they disclosed in the financial statements? Now, the lessee, that is the person that is borrowing the assets, is required to separate assets that are on lease, that is right of use assets. They are expected to separate it from other assets. That is, they should clearly state it that these ones are on lease. These ones are our PPE. When you hear PPE, you know that those ones are property, plant, and equipment that are actually owned by that entity. But the ones that are on lease, they should state it so that they will not just lump, even if they are both building, but you know that one you own it, one you lease it, the entity will specify, they will state it separately that this building on lease, building that we own. Mhm. Then apart from that, that is in the statement of financial position, of course. That's where we show buildings. That's where we show assets. In the statement of financial performance, they also need to present the interest expense that they are spending on the lease. They will show it in the statement of financial performance. And then the depreciation that they charge also on that asset will also be shown in their financial performance. Those are expenses. Okay? Apart from financial performance, they are also expected to show their lease payment in their cash flow statements. So the lease payment that they make will be shown in their cash flow statements. The interests they pay on the lease will be shown as part of their financing activities in the cash flow statements. Then their variable lease payments also, or short-term lease payments that are not included in the measurement of the lease liability will also be presented under the operating activities of the cash flow statements. Okay. Now, apart from showing all of this, these are showing specific figures that relates with the lease. You are showing the assets, the liability figure. You are showing the interest you pay in your financial performance. You are showing the depreciation you charge on that asset, also in your financial performance. You are showing the interest you paid in your cash flow statement, the payment, the lease payment you make. You are showing it in your cash flow statement. Now, apart from all of that, you are still the entity is expected to disclose certain other informations, other detailed information about their lease properties. So the carrying amount of that property at reporting date, they need to disclose it in their notes to their financial statement. Contingent rents, they also disclose that as part of the expense for the period. What are contingent? Contingent rents are rents that they pay on the property, but it's dependent on certain. I mean, it's dependent on certain events. Okay, so that is not is different from the fixed payment. So the contingent rent will be part of like the variable payment that we talked about before. So these ones are not fixed, but it's dependent on if certain events happen. So maybe it can be part of their agreement that okay, as the lessee that is borrowing this asset, you also have the right, you can lease it out. If you are not using it, you can also lease it to somebody else. But if you do that too, you pay extra rent to the lessor. So that's the kind of contingency rent that if it happens that you lease it out, then you pay me too, part of what you collect. So all this will be stated in the notes to the financial statement. Um, the total of the future minimum lease payments will also be included. A general description of the lease agreements is expected to be disclosed also in the notes to the financial statement. So that's about the finance lease in the books of the lessee. But if it is an operating lease, in the book of the lessee, there is no really much to do because the lessee is not keeping the assets ownership, he's only borrowing. So basically, what will concern the lessee in the case of an operating lease is the money that they are paying. That is the rentals, the lease rentals that they are paying back to the owner of the asset. That is the basic thing that will concern them. All right. So they will, and then the liability that they have. Okay. So the lease payments under an operating lease will be recognized as an expense on a straight line basis over the lease term. So if the lease term is 5 years, every year you charge the lease payments into your income statement, your statement of financial performance. And then apart from that, they will also disclose uh, the lease and sublease payments recognized as an expense in the period. Any amount you charge in the period, you disclose it in your notes. The total future payments, you also disclose it in the notes to the financial statement. Then a general description of the lease agreement as well. So that is about the book, the records of the lessee, that is the person borrowing the assets. Now, in the book of the lessor, if it is the lessor that want to keep records now, finance lease, operating lease. Now, in the book of the lessor, if it is a finance lease, the lessor too does not have much work to do because you know that the lessor is not keeping the assets in their own records. The ownership is with the borrower in the finance lease. So, in that case, basically what the lessor keeps is the receivables that they are expecting from the lessee. All right. As the lessee, that is the borrower of the asset, as the lessee is recognizing liability that they will pay into the future on that assets. Okay, so let's say our tractor that we're talking about, that I am borrowing from you to use. That tractor, as I'm recognizing the liability that I will pay for the next 6 years in my own records, You that borrow me the asset, you also, as the lessor, you will be recognizing the receivable of that money that you are expecting from me. Okay, so the lessor will recognize lease payment receivable in a finance lease at an amount that is equal to the net investment in the lease. So what they will recognize, what the lessor will recognize is the present value of that future payment. Okay, the present value of the future payment. Then they will also recognize the interest rates in the lease to measure the that is used to measure the present value at the initial measurement. All right. Then, if they have initial direct costs, because the lessor can also have initial direct costs. So if they have initial direct costs, it will be included in their initial measurement of the net investment, that's present value of the future lease payment, lease receivable, right? And then subsequently, they will recognize uh, finance revenue, that is the interest on that lease over the lease term. Okay. The lessor will also disclose a general description of the lease. The financial statement, they will disclose a general description of the lease. They will disclose if there is a contingent rent that they receive. That is, the one that they were not planning to receive before, but just happened based on the agreement that they have with the lessee. They will disclose it in the notes. Then they will do a reconciliation between the total gross investment in the lease at the reporting date and the present value of the lease payment at the reporting date. So those are basically what the records that the lessor need to keep in respect of an operating lease. Sorry, in respect of a finance lease. But if it is an operating lease, in this case, you know that the lessor, the owner of the asset, will still be the one that will be keeping record of his own assets because the ownership right of the asset remains with him. So in this case, his asset will still remain in his financial position. You will be charging deviation doing normal things just like the asset is there. But at the same time, okay, you will recognize the lease payments that is expecting from the lessee. You will recognize it as revenue, all right, on a straight line basis. As that's fixed payments that will be coming every year. You will recognize it in their in its financial performance as revenue when they come in. Okay, so you now say lease revenue. You recognize it when they come in. All right. So and then they will also recognize any costs that they incur on the lease, including depreciation. So any cost they incur in earning that lease revenue. If they do maintenance, they will recognize it. If they do insurance, they will recognize it as costs on the lease. They will recognize it in the financial performance. As they are recognizing the revenue from the lease, they are also recognizing any costs they spend on the lease. So meanwhile, the assets will still remain in their financial position as their own assets. So how do they measure it? Okay, so the lessor will measure, will add the carrying amount of the lease assets and the initial direct cost, and then they will expense it systematically over the lease term. Okay, and they will also present their assets. Okay, I've mentioned this one in their financial position. They are apart. So as they are recognizing revenue from the lease, recognizing the expenses they spend on the lease, that their assets will still remain in their non-current assets in their financial position. So that is about uh, the brief summary of Ipsas 43, which is on lease. Okay, so basically here you need to be familiar with the recognition criteria, the measurements, and then the disclosure requirement. Okay, so the, the questions that can come in that topic cannot really be sophisticated calculation questions like that. So they will only be asking you for the accounting treatment. That okay, how do you show the accounting treatment? And of course, once we have told you that you recognize the asset, you recognize the liability when the lease happens as an initial measurement in the book of the lessee for a finance lease. So you recognize the assets by doing what? You debit your assets, and then you recognize the liability by crediting your liabilities as initial measurement of the lease. Then subsequently, what do you do? Subsequently, what do? You you depreciate the assets, that is by debiting depreciation and crediting accumulated depreciation. And then,
Please, your screen is not showing it green. No.
okay, yes, I intentionally came into the call. I'll go back there when we want to continue with the next um, standard. So, any question on lease so far? Okay, no question. All right.
I have a question.
Okay, go ahead.
It's about the present value. Please, can you explain the present value? And I know you didn't work on computation of lease, sha, but when you are computing it, are we using the present value or the fair value?
When you're competing, what?
Lease schedule, like the payment process. There's some calculations in lease apart from the um journal entry. There's
Mm,
some
mm,
relation they do. So
mm. Yes, what I'm saying, that's what I said, that mostly what you can expect under as a kind of calculation in Ipsas 43 will not be beyond asking you to state the accounting treatment, show the ledger, the journal postings of how to account or how to measure a lease transactions. Okay, now you first asked about the present value. The present value is talking about the all the future values that will be of the future payments on a lease. You discount it to present value using your normal discounting procedure. All right, a normal discounting procedure at an interest rate that will be given to you. So you use the interest rate that is given to you, get your discount factors, apply it on the uh, annual lease payments, and then you get your present value of the future lease payments. Okay, and that is used for the purpose of trying to compute the initial measurement of the lease liability of that asset. Okay, so it is that you add to any other cost that is incurred that will now give you what is the lease liability as the initial measurement of the lease liability. So it is that amount that the lessee will recognize as an asset and as a liability in their financial position. Okay. So subsequently over the as the years are going by, they will now be making the lease payments. Now when they are making the lease payments, the difference between the 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 systematic depreciation of that value. Okay, let me use a figure. Let's say the future lease payment, like I said in the tractor, is 2 million every year for the next 6 years, which makes 12 million. But now we use discount factor maybe 10%, and then we discounted that 2 million for 6 years. We discount it to present value, and maybe it now runs to, let's say, 7 million. Okay. Now that 7 million is what I will recognize as the uh, cost of the asset. That will be the value of the lease asset. That will recognize as both asset and liability. Right? That is the initial measurement. Now, subsequently, in the financial statement, the way they will recognize subsequent measurement of that lease is that in our lease agreement, we have already agreed that I will be paying 2 million every year on that tractor. Now, by the time you divide 7 million by 6 years, whatever you get, that's the depreciation of that asset, because you are using a straight line depreciation. Abi? Now, the difference between that amount and the normal amount that I am paying every year is the interest on that lease. That is recognized in the financial performance as interest expenses every year. Okay, so I don't know if I'm able to answer your question, Sha.
Thank you, sir. Yes.
So these ones, these other two standards will not really take much time. Ipsas 9, revenue from exchange transaction. I believe you are still seeing my screen now. Okay. So revenue from exchange transaction involves, okay, when we say exchange transactions, in simple terms, we are talking about a transaction that involves giving something of value and receiving value in return. That's an exchange transaction. We give value, we receive value in return. So we have done an exchange transaction. Okay, we sell goods as a government entity. We sell forms for we sell fertilizer. Ministry of Agriculture. We are selling fertilizer. We receive money. Okay, um, whatever ministry they are selling rice, and then we receive money. That's an exchange transaction. Or Ministry of Environment, we clean the environment for you. You pay us money. It's an exchange transaction. Okay. Or as a government, a state government or local government, we pay money to Elizade. Elizade gives us what's it called? It gives us Hilux trucks, or Hilux van, whatever you call it. Hmm. Or you give us Prado Jeep. You give money to Elizade, you give us Prado Jeep. That's an exchange transaction. Okay. Now, but in this case, in the case of Ipsas 9, we are looking at it from the angle of revenue now. We are streamlining it to revenue transactions. Okay, so as a government entity, those exchange transactions that we engage in that result in we making revenue. Okay, so if we make revenue from it, from that exchange transaction, this standard is talking about how to go about those transactions. So what are those transactions? The examples I gave earlier, we give you fertilizer. We are the Ministry of Agriculture. We give fertilizer to farmers. We collect money from them. Okay, that's an example. Or we sell our used cars that we are no more using. We sell the cars, we receive money. So this standard is talking about the revenue that government entities generate from a transaction that involve them giving value and receiving value in return. Now, Exchange transactions can come in different forms. Example is the one I just gave, where you give fertilizer, and that is a sales of goods. Okay, it can come in form of a sales of goods, can come in form of provision of services, it can come in form of investment income. Okay, so we look at the different parts, the different ways that a government entity can make revenue through exchange transactions. You know that government can also make revenue through some transactions that are not exchange transactions. That is, does not involve giving and receiving of value. For example, I think there's another standard I even talk about that one, revenue from non-exchange transactions. So I believe if you understand this particular one very well, you can go ahead and read up on that other standard, and it will be very easy for you to understand. Since you understand the one from exchange transaction, it will be easy to grab the one from non-exchange. So examples like tax, government receive revenue from tax, but they are not giving value back for the tax. It's not like government will say, "Oh, yeah, if you want to pay your tax, you pay tax, we'll give you car." Except that is a promo, sha. I don't think government does promo on taxation, sha. And they say, "Oh, yeah, if you pay tax and get a three-bedroom in Banana Island." So tax is not an exchange transaction. That's the point. So government does not use something to trade for tax. Yeah, you will collect it. It's compulsory for you to pay. Another form is a grant. So they get grants. It's a form of revenue, but it's not an exchange transaction. They don't give something in return to receive grant. So those are non-exchange transactions. But the focus of Ipsas 9 here is on the transactions that are exchange transactions. So the money that government receive as a result of engaging in transactions that are exchange transactions. So one of them is sale of goods. So how do they recognize revenue from sales of goods? So that is the main purpose of this standard. The revenue that government make from sales of goods, how do they recognize it in their records? So when we say sale of goods, is involved when goods are produced or a goods that is purchased by the entity for resale purpose. So they purposely buy goods or they purposely produce goods because they want to resell uh, these goods. And it's also it's even include lease of PPE. So if they lease a property and receive money in return, that's a revenue from exchange transaction, right? They are collecting money, they are giving assets in return. Okay, so if government buy buses now and decide to give it on lease to some people, it's an exchange transaction. Now, how do they recognize revenue from these transactions? So the standard says that revenue from sale of goods should be recognized only when they meet all the following conditions. Okay, so revenue cannot be recognized if in a sale transaction, if all these conditions are not met. Number one, it has to be that the entity has transferred the risk and reward of ownership of that goods to the buyer.
We
Okay.
can't hear you any longer. Please come again.
Okay. Are you the only one that's not hearing me, or everybody's not hearing me? Please let me know.
That your voice is very low.
We can hear you.
I hear you.
We can hear
I
you,
hear
sir.
you, sir.
We can hear you.
Okay.
We can hear you, but your voice is low.
Uh, okay. And it's night now, so definitely it's normal for voice to be low at night. Also, I've gone through stress all day. Uh, all right, so I'll try and adjust the voice. Mm. Okay. Okay, so let me go back to the next. So for revenue to be recognized from a sale transaction, the entity must have given the goods to the buyer. They must have transferred that goods to the buyer. In essence, what we are saying is that we said we are Ministry of Agric. You are in public sector class. We are Ministry of Agric, and we say we want to sell fertilizers to farmers. If the farmers gather money that they want to buy fertilizer, they give the money to us, and then they have not collected their fertilizer. In that case, we have not made sales because they have not collected the goods. So all the money that they gather to give us is not yet revenue. We cannot recognize it yet as revenue. So these are cases. I'm trying to give examples like this so that if a question can come in this kind of standard, it will come in a case study way, a case, and then they'll say they will ask you to comment on it and say, okay, what should they recognize as revenue and all of those things. So, and even if it's coming in form of calculation, once you understand the concept behind it very well, you know how to move your way around the calculation. So in a situation like that, we collect money from farmers, we are not giving them the fertilizers, we have not made revenue. All right. So at best, that money that we collected from them is a liability to us because we collected the money, we have not given the value. So this standard is saying that if you collect money until you give the goods to the buyer, that is when you can now recognize that money as revenue. Now, the second condition is that the amount of revenue must be reliably measurable, of course, and then it is probable that economic benefits associated with that transaction will flow to the entity. It is probable that, it is very, very probable that that transaction, as we are doing the transaction like this, you will receive money. If you are not going to receive money, you cannot recognize that money as revenue. It's not likely that we are going to receive money. You are not going to recognize that money as revenue. Hmm? And you are selling uh, goods to your mother-in-law, and you are expecting to receive money. Until you receive that money, don't record it as revenue. Don't record it as revenue. You said to your mother-in-law until the woman decides to pay, and you collect the money because you can decide not to pay, and if she doesn't pay, nothing you should do. Ehen. So that's by the way anyway. So in a situation like that, even it can happen in a government entity, especially in this our kind of governance that we have here. Okay, so as we are selling our fertilizer jeje in Ministry of Agric, and then the chairman of the political party of the governor comes and say you want to buy fertilizer, and he collected 100 bags and say you send the money to your account, send your account number to my PA. You as the government officer, can you stop the chairman of the political party from collecting fertilizer? You can't now. So you collect the fertilizer and say you will pay, and it goes. Until you receive the money, don't record that revenue because it's not probable that you will get that money. Okay. So the next time we are saying is that when it is probable that you get the money, you recognize the revenue, even if you have not gotten the money. If it is probable that you get it, yes, you recognize the revenue. Another condition is that the cost as is associated with that transaction can be measured. Of course, if you want to measure sales, for you to recognize sales, there must be expenses, there must be costs of making that sales. That's why we always have sales revenue, then we have cost of sales. So if there is no cost, there is no revenue. And then the entity does not restrain ownership or control over the goods. You cannot say that you sell goods to somebody and then you are still not allowing the person to carry his property. In the situation like that, you have not made revenue because if the person decides that I pay for something, you are not giving it to me, you are giving my money back. You return the money. So these conditions are those conditions that must be met for an entity to say that they recognize revenue from sales of goods. Okay. Now, apart from sales of goods, an entity can also make revenue from provision of services. According to Ipsas 9, if government entity uh, provide services and then they charge for it, the revenue they get from the provision of services will be recognized if these conditions again are met on that one. Okay. Now, if they can measure the amount of revenue reliably, of course. If you cannot measure revenue, how do you record it in the financial statement? Financial statement only the financial performance only recognize figure. uh Then the stage of completion of this transaction at the reporting date can be measured reliably. You know, this one is provision of service. It's not goods. Goods does not have problem. It's either you have delivered the goods or you have not delivered the goods. uh But in the case of service provision may take time, and at the reporting date, you might still be in process of providing that service. So in a situation like that, the level of service that you have provided is the proportion of the revenue from that transaction that you recognize in your financial statements. Let's give an example. Okay. Let's say we are Ministry of what can we call ourselves this time? Let's say we are the state um, waste management. Let's say we are the state waste management agency. Okay. What do you call this one in Lagos? Loma, Abi. Let's say we are Loma. Now we have a services. You know the park debts, Abi. The park debts around. Now we have another services that we offer that we help people to clean their environment. Let's use that as an example. That we are Loma now, and part of our services is that we clean people's environments and then they pay. Okay. Once they pay to government accounts, we come there, we clean their environment. And then one company, they just finished building their company, or maybe they have been using the company, let's say Nestle or flour mills, just say, okay, our factory is very dirty. This is December, we want to clean our factory. And so flour mills just employ Loma to come and clean their factory for them. So we started the work on 28th of December and then 29th, and then New Year came. We took a 2 days break, and then to the following to January 3 before we continue. As at the end of that financial year, the level of work that we have done in that place doing the cleaning is the amount of revenue that we will recognize. Let's say the contracts for the cleaning is for 50 million to clean the whole place. But as at the time that the year ended, we have only cleaned about maybe 30% of the place, or okay, let's say 50% of the place. We have only cleaned half of that factory. In our financial statement for that year, we only recognize 50% of the entire revenue of the contracts. So let's say this is 50 million, Abi. So we only recognize 25 million as revenue in that year. The remaining 25 million will be recognized in the other year after we have completed it. All right. So revenue will be recognized based on the proportion of service that has been provided. If it is a service provision, all right. So that is why it is important. It is a condition that the level of work done must be reliably measurable. Another condition is that it has to be probable that economic benefits will flow to the entity, of course. And then the cost of transaction can also be reliably measured. Mhm. So that is the conditions for service provision. We have seen the conditions for goods and service for goods, for sale of goods. So if we as a government entity say we are selling goods, for us to recognize the money we make, we must meet those conditions. If we say we are providing services, for us to recognize the money we make from service provision, we must make we must meet these conditions. Then other forms of revenue sources that also involve exchange transactions. All right. Revenue can come from interest, can come from royalties, can come from dividends. Okay. Now, when revenue arise from the use of the entity's assets by others, and then it results in interest, royalties, or dividends, we will now recognize this revenue according to these rules from Ipsas 9. So Ipsas 9 says that in the case of interest, interest will only be recognized on a time proportion basis. So it will take into account the effective yield on the of the on the assets, right? So interest will be recognized using the rates on the of the transaction, and then based on time proportion. So if, for example, we decide to keep some money in fixed deposits as an entity, we say, okay, let's keep this money in fixed deposits to earn interest, and we kept the money in October for a 6 month duration. At the end of the year, the fixed deposit will still be there, and we will earn interest on it. The interest on that deposit that we will recognize in that year will be the one that is proportionate to this particular year. Okay, so that is for interest. It's on time proportion. So the number of months or number of weeks in that particular year that the asset worked is the amount of interest that we recognize as revenue for that particular year. Now, if it is in case of royalties that government gets from maybe mining natural resources that it gets from mining companies. So that one, we will only recognize revenue that we get from royalties in accordance with the substance of the relevant agreement. So that one will be based on the agreement that we have with that company that is paying the royalties. Okay. In the case of dividends will only be recognized when the entity's right to receive that dividend is established. Okay, you know that governments also can have investments in companies. All right, there are several governments in Nigeria, states, federal, that have shares in banks or some other companies. Now, for them to recognize dividend that they get from those investments, it will be recognized only when their rights to receive the dividend has been established. And what establishes the right to receive dividend? That is when the company that is paying the dividend has actually declared dividend. Okay. So if a company, if let's say Oyo State government have shares in First Bank Holdings. Okay. Oyo State government will not recognize dividend in their financial statement until First Bank declares dividend and say, okay, oh, we are declaring dividend for year 2024, and what we are declaring is 5 naira per share as dividend. So that's when Oyo State will now say, okay, how many shares do we have in First Bank? We have 2 million shares. 5 naira times 2 million. They will now recognize their dividend, because that in that case, because the company has declared dividend, it is established that they will receive the dividend. All right. So other exchange transactions that can also result in revenue for governments can include rent of government buildings. So governments can rent out their part of their buildings to people, and then they will receive money. It's an exchange transaction. We give you building, you give us money. Abi? Now, how do they recognize revenue from buildings, from rent of buildings rather? So they will recognize it in accordance with the terms of the tenancy. So the terms of their agreement with the tenants is how they will recognize the revenue. If we say every March 1 is the due date for the tenants to make payments for rent, so automatically every March 1 we will recognize revenue on that building. So even if the person have not paid, we will recognize the revenue because we know that we are it's already due for us to get revenue from the tenants. Okay, so based on our agreement, we will recognize revenue. Revenue can also come from transportation for government entities. Okay, so government can buy vehicles and then be using it to run different routes. Government can construct rail and you know collect fare from people that apply the train. So in the case of transportation, revenue from transport fare that government charge to passengers for the provision of transport is recognized as the transport is provided. So they will only recognize revenue as they provide the service and collect money. Okay. So when they provide, just like goods, that it is when you give goods that you recognize revenue. So the same thing with transport, it is when they provide the transport service, they carry people from one place to another. That's when they will now recognize revenue. Okay. Then revenue can also come from which other one? From management of toll roads. So toll roads, when governments collect toll from roads, like the one they collect in Lekki, Abi. So it will be recognized um, based on the usage of the road. So as people are using the road, they are making the payment. That's when government will recognize. It's not that government will now say, we think that we should have 20 cars that will pass this road today. Oh yeah, we recognize the value of 20 cars. No, remember. Then they can also recognize revenue for management of facilities or assets. So when they manage facilities for other entities, then they can recognize revenue based on the contract term that they sign with those people. Okay, and then from installation fees, government can have an agency that install maybe solar energy for people. That people can go there, buy solar installation equipment, and then they will install it for them and all of that. So in this case, they will recognize this revenue with reference to the stage of completion of the installation. So the level of completion, if it is 100% complete, they will recognize the revenue fully 100%. If it is 90% complete, they will recognize 90% of the revenue. If it is 50%, they will do the same thing. So uh, measurement and disclosure, how do they measure uh, revenue from how do they measure revenue from exchange transaction? So revenue will be measured at fair value of the consideration received, that is the money received, the amount that is received. That's what they call consideration, amount received. Mhm. So amount received or receivable, and it also includes only the gross inflow that is taking into account the amount of any trade discounts and the rebates allowed by the entity. In essence, what we are saying is that to measure revenue from exchange transactions, you measure it at the fair value, the amount that is received or that is receivable. Okay. Disclosure, what are the information that is necessary for entities to disclose with respect to their um, revenue from exchange transaction? So they will disclose revenue from exchange transaction uh, in the financial statements of the period that they relate. Okay, so whatever revenue they make, those revenues are expected to be disclosed in the financial statement of the period when they make that revenue. All right, so they will not go and be reporting revenue of 2024 inside the cash inside the financial performance of 2025. Okay, and then they also state the accounting policies that they adopt in recognizing the revenue, the significant exchange rates. Okay, the significant exchange revenue, rather, the significant exchange revenue will be recognized. I'm sorry, will be categorized in the financial statements. So they are expected to categorize all those revenue that they make from exchange transaction into the different categories of exchange transaction. Okay, non-tax revenue, investment income, interest earned, then capital receipts. So that is about Ipsas 9. Okay, any question? Any question? Okay. If there is no question, let's quickly run through the last one. I just want us to complete the
Yes,
three.
I have a question.
Okay, please go ahead.
Um, my question is based on, sorry, I have to take you back a little bit on that finance list. Is there, how, can you give an example of how we can have a finance list with interest? Example of a finance list that will go with interest, because you mentioned something about the treatment of that interest in
About
the
example of
book of
finance
the
list
year that
with
has
what?
an interest.
That has interest.
It has interest, yes. Then you make mention of how it, the treatment in the book of the let so the list. Yes, the list. I
Okay.
think you understand me.
Basically, a finance list will usually have interest. Okay. Now, the interest is how do we know the interest? A finance lease involves annual payments into the future. I give example of, say I give example of, say, you have a tractor. I am borrowing your tractor on lease, and the two of us both agreed that I'll be paying you 2 million naira every year. Okay, we both agreed that I'll be paying you 2 million naira every year for the next 6 years as the lease payments, as the annual lease payments. Now, that 2 million naira every year is the annual lease payment, right? It will now be discounted to present value using the interest rates that you are giving. That is, the interest rate you will be giving is usually maybe the cost of capital of the entity, or you are giving that the interest rate that is implicit on the you shall be giving the interest rate that is applicable to the entity. Now you use that interest rate to discount that future payment, that 2 million for 6 years. You discount it to present value. Now when you discount it to present value, that amount is now the fair value of the property that we want to lease. So that is the amount at which the lessee will recognize that property in their financial position as an asset. And of course, they will recognize this also as a liability. Okay. Now, you know that when they discount that amount to present value, it will be lower. Okay. That's 2 million for 6 years, that is 12 million. By the time they use the discount rates, the interest rates to discount it to present value, I gave an example that it may be maybe I'm just giving a rough figure that maybe it's 7.5 million. Now, if you now divide that 7.5 million by the number of years of the assets, that is the depreciation rate of that asset on a straight line basis. Agreed. So the amount that you will be paying back, let's say it is 1.3 million. So the amount you are paying back, which is 2 million, that me and you have agreed that I will be paying you 2 million every year. That 2 million minus the depreciation of that asset is what results to the interest amount on the lease. Okay, so if the depreciation of the asset is now 1.3 million annually, and our lease payment agreement is 2 million, so which means that 700,000 on it is the interest, that is the additional interest that I am paying together with the lease. So that's how you come about the interest on that lease. I hope it
Thank
is
you,
clear.
sir. Yes, yes, yes. Thank you, sir.
So quickly on investment properties. Now, when we say investment property, Ipsas 16. Investment property is also in IFRS. Yeah, I can't remember the codes. So when we say investment property, we're talking about properties that an entity have, but they are not using it for normal operations. If you remember the definition of PPE, the definition of PPE says that non-current asset that the entity owns, that they are using for production, supply, or they are using it for administrative purpose. That is PPE. But in the case of investment property, a property that is a property that an entity owns, but they are not using it for production. They are not using it for supply or distribution. They are not using it for administrative purpose. But they have it. They are keeping that property. They are keeping the property
Really,
for the purpose of capital appreciation or for the purpose of earning rentals on that asset. Okay. Excuse me, please. Let me just sip water.
Maybe I can excuse me, please. Let me just speak for. Okay,
So an asset they are keeping for the purpose of capital appreciation or for the purpose of using it to earn rentals is what they will regard as their investment property. So if an entity buys land or they buy a building and they keep it, that okay, this building or this land will keep it till when the value will increase. Those lands do appreciate. So they say let's buy this land and keep it till when the land the value will increase, then we will now resell it. So that is an investment property. Or they buy a building and then they rent it out to some use to other people. Okay. that is an investment property. Okay, so let's look at what are the provisions of Ipsas 16 on this investment property. Now, what are the examples of investment property? Like I just mentioned, when you buy land that is held for capital appreciation, when you buy a building, uh, even if it's under a lease, or a vacant building that is held for intended future use, for intended future lease rather, is also investment property. Property that is completely constructed for future use as investment property regarded as investment property. Now, there are some items that are not investment property that we cannot regard it as investment property. See, this area is the question area that you can ask question on. If they also have question on this standard, so they want to test you if you actually know the difference between what can be regarded as an investment property and what cannot be regarded as an investment property. Okay, property that is held for sale in the ordinary course of operation, this one cannot be an investment property. It is what inventory. Okay? If you have a property that is held for sale in the ordinary
Okay.
course of business, that is inventory. Then property that is constructed on behalf of external parties. Okay, so if you are a construction company, or let's say we are Ministry of Works or Ministry of Housing, and then we construct building for another person, that is not an investment property also. It's just like an inventory. Owner occupied property, that is the building that the owner is using, the entity is using as our office or our warehouse. We cannot regard it as investment property. Then property that is under construction for future use as investment property, we are still constructing it. Cannot regard it as investment property yet. A property that is held to provide social service, all right, even if it generates cash flows, but because we are using it to provide for social service, let's say we have a park, maybe something like a park, people pay to enter a park, but still we cannot regard that property as investment property because purposely it was constructed for social services. So which means we are not expected to say we are going to sell it in future to earn capital appreciation on it. Okay. Um, or to earn capital gain rather. Then which other one? Okay, property that is held for strategic purpose. All right. This one will not also be regarded as investment property. Now, measurement of uh, recognized investment properties. So we have known what we can regard as investment property, what we can recognize as investment property. We have known them. So how do we measure them? Okay, so investment properties are usually measured using the fair value model. That is basically the basis is to use fair value model for investment property. So unless there's clear evidence when the entity first acquires the item that the fair value of the asset is not reliably determined. So if that is not the case, it is expected that investment property should be measured at fair value. Now, we can use cost model to recognize investment property, and that will happen only when you know that the fair value cannot be measured. So in that case, use cost model minus any accumulated depreciation or any accumulated impairment. Okay. So how do we treat uh, uh, disposal or retirement of investment property? That is, if we say we buy land, or capital appreciation, they are treating it as investment property. By the time we now sell the land has appreciated and then we decide to sell it. So we have now sold the land. How do you now treat that property in our financial statement? So it's simply the the property will simply be eliminated from our financial position on disposal, okay? Or when the property is permanently withdrawn from use and no future economic benefit is expected from its disposal. So what we'll simply do is to withdraw it from our financial statements as an investment property. And in terms of disclosure, of course, the entity is expected to disclose the depreciation method they use for their investment property, the carrying amount of the investment property, the measurement basis they use for the investment, whether it's fair value or cost model, they're expected to state in the financial statement. They will disclose that investment property in their statement of financial position. If you remember, like I said earlier tonight, that the non-current assets that entities have take different forms. There are those that will be in form of PPE, that is those ones that they are using for production, distribution, and administrative purposes. Okay. Then there are those that will come as lease property, right of use assets, and then there are other ones now that will come in form of investment properties. So it will be disclosed separately and shown that it is an investment property. Okay, so that is the little I have for us in terms of these few standards, these three standards that I just mentioned. So we have talked about tonight. We have talked about three standards: Ipsas 43, which is lease; Ipsas 9, which is revenue from exchange transactions; and Ipsas 16, which is investment property. Any question? Do you have any question regarding this? Okay.
Hello, sir. My
Yes.
question is, in case that there is we have an asset, we invest an asset, or you might call it an inventory now, that we are using for lease, the property, so
Mm.
we are using it for lease, and we are generating income for the entity. Then we now have some of our staff that is using the building. So we now give it to them as maybe as a rate, discounted rate, or we use part of it for the staff to be staying here. Can we still recognize that investment property? And if not, how are we going to recognize it in our?
Okay. You have the NCC has buildings that their staff are using as accommodation. Abi?
Yes, sir. Yes, sir.
Okay. So we want to know if that building and they are paying rent on it at
Yes,
discounted rates.
yes.
You see that at discounted rate that you have mentioned has has, has negated it from being an investment property. Okay. If you remember when we said the items that cannot be recognized as investment properties, we said the property that is being used as a social services, even if you even if you if there's cash flows that come from it, as long as you are using it as a social service, it will not be recognized as investment, right? Because this one now you are using it as a form of welfare service for your staff. Okay, if you have the building and you rent it out normally to people, and then some of your staff also decide to rent from it, yes, that is an investment required because definitely they will pay the normal rate that other people will pay. Ehen. So that one is a different case. But if you give it to your staff specifically at discounted rate, that is not an investment property. That is your PP. It's a PPE. You recognize it as a PPE of your entity. You depreciate it normally as your PPE. Yes, that's to the best of my knowledge. Okay, is that clear?
Yes, sir. Thank you, sir.
Okay. Any other one before we wrap up the class?
Sir, I want to just ask something. It's not a question. I want just know if we have treated public debt as a topic.
Public debt.
Yeah.
Actually, it should have been treated. Sorry, I sometimes I don't
Because
usually
I
follow the
have
class if I'm not
because
the one that is if I'm not the one that
because
is taking it. I'm not usually following the class, so other people can testify if it has been treated.
yeah, because the group is not open for me to trace because after going through all the from the day one to date, I'm not seeing anything like public debt. So that's I'm wondering whether
I
if
think I saw one that because I was the one that compiled that list of topics that have been treated. I think somebody have treated public finance. So if they have treated public
yes,
finance,
yes, public
public debt
finance
is
and
inside. Yes, public debt is inside public finance. It's inside public
no,
finance now.
it's not there.
Pub, public finance involves public finance involves public revenue, public expenditure, public debt. You understand? So if you treat public finance, you have to mention you have to talk about public revenue, you have to talk about public expenditure and then public debt.
No,
So I don't know, I didn't
I think
attend the
the
classes,
lecturer,
so I
yeah, I
don't
do
know
attend the classes
how far the
because the public revenue we took public revenue before public finance.
okay. You say public revenue
So
before public finance.
yes, we took public revenue before even we took public expenditure before public finance. I think public finance is the lecture 14, if I'm not mistaken.
Okay. So you're saying public debt was not treated.
Mm-mm.
Okay. Uh, I don't know how that will want to go. Okay.
So I don't know if my other colleague can confirm.
Mhm. Okay. Anybody in the class that can confirm to us whether public finance was treated,
No, public debt,
I mean
not public
public
finance.
debt rather, whether
Yes.
public debt was treated.
within the public debt.
Okay, you didn't do public
And
debt.
yeah, and it comes out in the first question.
Yes, that's why I'm asking because it comes that is the highest number of the followed by the budgetary control.
Okay, that's true. Okay. And the classes are already winding up. I doubt if there is any other class even this week.
Yes, that's why I come in. I don't know if they if is what you can help us to talk to the tutor if they can treat it on Friday because we are meant to have Psaf on Friday after tax. We are yes after tax we are meant to have Psaf, so I don't know if they can
If
take
the
it
tutor
up.
can take it, Abby.
Yes.
Uh, anyway, I'll mention it to the I'm not even sure that I'm not sure of the particular person that is supposed to take that part of the syllabus anyway. But I will mention it in the to the tutors. So the person that is supposed to take it will
Mm.
probably uh, work on that. But if that did not happen too, you have to go and read it. You have to read it. You have to go and read it on your own. It's theory basically now. There's no calculation there, so it's something you can
Yes,
read.
there's no calculation, but the
So it's
question
just
is
only
very
about
tricky.
the topic is just about the different borrowing instruments, then debt
I think the
management.
topic is
Those are
wide, where we have
key
the
areas there.
debt conversion, debt sustainability.
And that's what I'm saying.
Uh,
Those are the debt management uh, strategies, the debt burden transfer, and all those things. Anyway, it's
please,
easy to.
help us to do justice to it. I beg.
I will mention is if the person is available, if he's going to be available on Friday, then he will come around to take it.
Okay, thank you, sir.
Mm. So if there is no other question, I think we
Good
can.
evening, sir. Sorry, please. I have a question.
Good evening, Mal. You're welcome.
Thank you very much for this lecture. Please, I would love to ask this Ipsas 43916. How does the question come out in exam? Is it just theory or does it have calculations, please?
I can't know that one. No. I'm not the examiner. It's the examiner that can know how they will ask you. There is no standard that they cannot bring calculation from, and they cannot bring theory question from. So it depends on what the examiner wants. They can try to bring calculation on it. They can try to bring theory on it, whichever way they want it. Okay. So, but the what I usually say is that once you understand the concept of that standard, even if they bring calculation, it is still the theory of it that will drive the calculation. It's the understanding of the concepts of that standard that will guide you to know what you should do with the calculation when you see it. All right. So that's what I
All right,
just believe.
all right, sir. Thank you.
You're welcome. So
Hello, sir.
thank you. All right. Hello.
Yeah, please. Now it's not really a question, but it's just like a request. Can we get the PDF file you use for this lecture?
This particular one, right?
Yes.
Yeah, I'll drop it. I'll drop it on the group.
Thank you.
All right. Let me call this person. We are done. Okay, so good night, everyone. See you guys some other time.
Good night, sir. Thank you very much.
You're welcome.